And the bears are back. Major indices turned red today, painting Wall Street in a sea of crimson. And it seems not even Jensen Huang strutting out his signature shiny leather jacket could save us from the relentless selling pressure. The market, well, it found Jensen's much hyped speech at Nvidia's GTC downright underwhelming. Investors hit the sell button hard, sending Nvidia tumbling more than 3% by the closing bell. So here we are with likely everything, and I mean everything, priced in, from AI dreams to lunar landings. Is the path of least resistance now pointing straight down after a couple of days of a relief rally? The S&P 500 already in correction territory, the Nasdaq 100 in deeper correction territory, and the Dow hanging on by a thread. And here's the kicker. What happens if we get slammed with another tariff headline? Trump's trade war threats have been swinging like a wrecking ball, and the market is as jittery as ever, with valuations still very, very lofty. So how low can this market go? Are we staring down the barrel of a full bear market, or is this just a blip before the bulls come charging back? Stick around, because we're diving deep into the charts, the news, and the chaos to figure out what's next for this wild ride. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks pulled back on Tuesday, led by a nearly 2% decline in the Nasdaq following 2 days of gains, as investors concerned about an economic slowdown look to the Federal Reserve's policy meeting tomorrow for insight. And guys, uncertainty still dogs this market as investors debate whether the sell-off that pushed the S&P 500 into correction territory is over. Many on Wall Street don't think the recent bump in stocks signals a clear bottom, as concerns mount that the president's trade war will hit already weakening economic growth. And we saw the rally halt today. Pretty red everywhere, including the mega caps, Google, Microsoft, Meta, Oracle, software as a whole really took it on the chin, hardware as well. Not even the Nvidia GTC event could save at tech stocks today. Nvidia was down 3.35%, Apple down 0.65%, AVGO down 3% as well. Financials were kind of flat, slightly down, but the bigger names did perform. JP Morgan, Bank of America, Berkshire Hathaway, they held financials afloat. We saw pretty green trade here in health services, and that was about the only sector that was broadly green. Even in stuff like consumer staples, we actually saw red across the board. And there was some pretty crazy headlines that came out. For example, Costco down 2%. They're having major negotiations with their Chinese suppliers to decrease the cost of goods on their end so that they can actually bring them in with regards to tariff concerns. Walmart is also having those very same conversations, and I'm sure all of these retailers are, to try and circumnavigate the costs associated with tariffs. And I think that sentiment led the market to move lower, along with the fact that we did rally 2 days in a row. Now, tariff concerns are still top of mind for investors. It's why gold was up 1.16%. We also saw energy up 0.15%, but this probably has to do with more geopolitical events and the movement of crude. Things are heating up in the Red Sea in the Middle East. Healthcare was up 0.03%, and then every other sector fell, with the S&P 500 down 1.14%, led by selling in discretionary technology and the communication service, the magnificent 7 sectors right here. And it was really just a flat day for the markets. We kind of just gapped down, and then most markets just traded sideways. There wasn't really anything crazy that happened today. No big news apart from Nvidia's GTC event. Growth, it took it on the chin. Large cap, mid cap, and small cap growth losing the most compared to their counterparts core and value. Value and core was the real way to play outperformance in the market today, but even then, you still saw mid cap, small cap, value, and core down on the day as a whole. Large cap core was also down nearly 1% today. Really, today was just another day where the bears saw value and really stepped in to take the market lower. However, this was largely just in North America, where we saw Canada and the US all together. However, Europe was pretty green. Asia was pretty green. The semiconductor belt of the world right here was kind of red, but Australia was green, South Africa was green, South America was green. Broadly, the global market did really, really well. It's just the US underperforming globally today. But despite US underperformance, we actually did get pretty good data today. Now, building permits and housing starts, the yearly figures came out. We beat the consensus estimates on both. Building permits came in slightly better than expected, 1.456 versus 1.45 consensus. However, housing starts beat in a very big way. 1.5 million houses were started compared to 1.38 million. Now, housing starts actually rose 11.2% from the previous month to a seasonally adjusted pace of 1.5 million. This data comes as mortgage rates have been trending lower ever so slightly. We recently hit a 3-month low. Mortgage applications are also up 11% month over month. And guys, I have to say, this is an expansionary number. It's hard to argue that the growth scare is anything more than a scare. I still don't see a recession imminent in the economic data just yet, but we'll see what the Fed says tomorrow. Now, a big market move, at least what everybody was focusing on, was Nvidia's GTC event. Now, Nvidia has this massive conference once per year. It was a sold out event. Tickets were $2,500. I actually got an invitation to buy one. Nvidia was sending those out to a bunch of YouTubers. I'm not going to pay $2,500 for a ticket. However, the annual GTC event saw Jensen Huang in the spotlight, telling everyone that AI is at an inflection point. During his keynote speech, Huang revealed General Motors is partnering with Nvidia to build out its own self-driving cars. Jensen also touted the debut of the company's Blackwell Ultra AI chip, set to arrive in the second half of this year. This is the next generation to the current Blackwell GPU. In addition to the Blackwell Ultra chip, Nvidia also announced the GB300 Super chip, which combines 2 Blackwell Ultras with the company's Grace Central Processing Unit. Now, the GTC event was largely uneventful, and as a result, Nvidia's stock fell 3% today. I think the market was looking for something a little bit more, but we didn't really get it. Everything, and Jensen told us, we kind of already knew everything was priced into the stock, and that is why we fell, along with the broader market just doing its usual churn this time of year. General Motors fell 1%. The partnership with Nvidia couldn't boost the stock. It did initially. However, partnering with Nvidia and Nvidia having some very expensive chips will weigh on margins as a whole. Nonetheless, this is a step forward for autonomous vehicles. And then we also had Google today falling 2.5%. This is because Google agreed to buy the cybersecurity company Wiz for $32 billion. The market doesn't like this deal. Even though it should bolster Google's cybersecurity, the deal for $32 billion puts Wiz at a valuation of 50 times sales. That's roughly equivalent to what Palantir trades at right now. So Google paying a hefty premium for the Israeli AI cybersecurity startup. Now, this deal was supposed to go through last year, but due to antitrust hurdles, it did not. I'm assuming Wiz and Google both feel the environment is far better right now to get this deal through. We'll see if it eventually happens. It does have to go through regulatory approvals first. As a result, the market saw 3,900 decliners, 2,200 advances. We actually did see net inflows for the NASDAQ 100 as well as the New York Stock Exchange, despite the S&P 500 being down only 1%. And then market momentum deteriorated ever so slightly today. The 5-day moving average continues to be above the 50% mark. We did see a deterioration, but these shorter term averages continue to remain a little bit strong, and hopefully that shift can move into the medium term averages, into the longer term averages. But what we saw today was a step down from yesterday. Momentum deteriorated under the hood. Now, looking at equities as a whole, we're a little bit upbeat here in the after hours, but after what is a red day, the S&P 500, the NASDAQ 100 down in excess of 1%, and we saw markets declining as a whole, except for the RSP. only down 0.5 percentage point today. So that really goes to show we did see a little bit of outperformance in the broad market, mid caps and small caps as well. So really just large caps taking it on the chin. But it was a day where we just saw equity sell off after 2 days of pretty solid returns. We saw value outperform growth today, and we did see volatility spike ever so slightly. The spot VIX is still higher than the front month contract, so we're still seeing a little bit of elevated near-term volatility, hence the selling. However, by tomorrow and by Friday, once we get this VIX expiration and the OPEX, we should see this revert back to normal, and then we can actually continue the movement higher. Yields did fall as a result. Today, the dollar fell as well ever so slightly, and bonds gained as a result. You think stronger economic data would boost yields, but look at the 2-year yield, 4% mark. Wow, guys, yields are really coming off their highs. Bitcoin down another 2% today. We'll talk about Bitcoin and gold up 1% for the most part. Now, looking at the S&P 500, if you watched yesterday's video, today's price action is absolutely no surprise to you at all. I said we are going to trade back into the gamma flip, and then we're going to make the next move to the upside or to the downside. And it looks like we moved to the downside. We are back in negative gamma. And that means we probably are going to go ahead and test this 54.85 area, or the lower end of the put support. This would actually be constructive for those that want to get into the market, because we did say that up until this March OPEX, this area right here is the buy zone, the 54 to 5500 area. And as long as we stay above this 5400 area right here into March OPEX, into the end of March, we stay above this zone, we likely put in a higher low relative to this low right here. And then we can actually make the next move to the upside. However, that will coincide with us taking out maybe this high and some of the other highs. And that would also mean we need to find support before we go ahead and hit this 5400 area. If we do pull back and slice right through this 5400 area, that doesn't bode well for markets, and then we will actually see lower price action and probably see a decline of 15% or more. But in the here and now, this area is looking like support. I mean, if we continue to sell off throughout the week, if we continue to sell off on the FOMC, as long as we find support in this zone right here at put support, there's probably nothing to worry about, and the likely outcome is that we do go higher in the S&P 500, at least into the end of March, into early April. However, below 400, that does open up a can of worms. Very similar situation in the NASDAQ 100, where a negative gamma, we pulled back below the gamma flip, and we're trying to find support inside this negative gamma area. Now, anything can happen tomorrow at the FOMC. If the Fed come out very dovish and, tell us that the economy is actually great, the market might rally on that optimism. However, I think a lot of that is already known. And the best thing that the Fed can do tomorrow is a rate cut. And I don't think we're going to get a rate tomorrow. I think the Fed's going to pause just to give themselves a little bit more dry powder in the future. There's no reason to cut rates at this March event just yet. Yes, we are seeing weakening economic growth, but it's not detrimental because the labor market is still hanging in there. And we know that is what the Fed is watching the most out of any indicator, because that's part of their dual mandate. Nonetheless, guys, in the NASDAQ 100, I'm a buyer here at the 19,000 level. For the S&P 500, that level is the 45.85. And for the RTY, that level is just below the 2000 year at the 1975 level. Now, the Russell 2000 showing a very mild outperformance. We are still in positive gamma here, finding support at the gamma flip. So we could actually see some very mild outperformance in the Russell 2000. And we did actually see that today. Look at the RSP, right? Look at the IWM compared to the NASDAQ 100 and the S&P 500. Quite a bit of outperformance, relatively speaking. We did see that value outperformed growth, and you love to see that. That's why we're probably seeing the Russell 2000 perform well. Also, these smaller cap industries, which are more domestic providers, tend to be less tariff sensitive, especially if they are manufacturing their products here. Yes, they will probably see a rise in commodity prices and in prices as a whole. However, they're just less tariff sensitive as a result. And that's partially why we're seeing slight outperformance in these names. Now, gold, on the back of tariff fears and slower economic growth, continues to just power ahead, now trading at the 30-34 level. And will we ever get to the 2700 area? I have no idea. I mean, it's looking like if we do pull back, the 2800 level is ultimately where we want to be. In hindsight, this is probably where I should have added initially to my position. I did not. So here we are. However, we will be patient with this trade And gold year to date, what is gold doing? Let's have a look on a percentage return basis, up 16%. Absolutely insane. Very linear returns here for gold in the last year. And if we actually take a measures move, what would the pullback look like to the top end of the range? 8.27% to the bottom end. It'd be a 9% pullback in gold. Nothing unheard of. It'd be very similar to the pullback we got right here. Yeah, it'd be very similar to that pullback. So not out the realm of possibility. One thing I am interested to note is if we put the global M2 money supply indicator, what does this look like for gold? What if we offset it by 30 days? And you guys can go ahead and actually find this indicator. You can actually just search FinFluential global M2 money supply indicator. You can actually put this indicator on your chart. So it does look like gold sort of follows money supply, but we don't have the outsized moves like we do with Bitcoin. Nonetheless, and it's hard to track, but you could very clearly see that as money supply has gone up, so too has gold. As money supply has traded sideways right here, so too has gold. But we do see quite a bit of a decoupling as well. Looking at Bitcoin, guys, 72 days is the offset you want to use. Let's actually go ahead and make this a line graph. And you can see that this blue line is Bitcoin, this yellow is money supply. And you can see that generally speaking, while we do decouple, the trend is more important than the exact level. And what we're really looking for at the moment, sort of a bottom to be put in here around about towards the end of March. And then we should see this move higher in Bitcoin. So we'll see if this actually continues to trend or if we actually get some form of a divergence money supply. Anything can happen. However, if history is any guide, we should see a bottom put in for Bitcoin. And as a result, that the money supply should follow into risk assets as a whole. And that should sort of put a support underneath stocks and risk assets as a whole. But we'll see if that is the case and if that does pan out. Guys, looking at the 10-year yield, we continue to consolidate here, sort of at this range right here. We're seeing a very healthy move back up, but nothing too crazy as to freak the market out. The DXY, the dollar, is actually finding support here at this 103 area. And I think we're going to continue to just sort of trade in this range, and then we'll make the next move to the upside or the downside. I wish I knew which way we're going to go, but I think the path of least resistance right now is to the downside to get to this $100 DXY level. So in the here and now for the NASDAQ 100 and the S&P 500, we continue to look for a low in the S&P 500. That's at 54 to 5,500. If we pull back, we want to find a low right here. If we can hold these levels, that would be constructive for us to move higher. And this is ultimately a great place where we want to be adding to our positions. Just remember, guys, when we have a 10% correction, barring the need of a recession, we normally resolve higher within the next 3, 6, and 12 months. So if we don't get a recession and this slowdown just turns out to be exactly that, an economic slowdown, this pullback should really be looked at as a gift, and any volatility you do get inside this 54, 5,500 area should be an opportunity for buy. Ultimately, our target should be to retake these all-time highs. However, in the year and now, sit through the volatility. The FOMC is going to be the big market mover. Don't try to predict what Jerome Powell is going to do. Just wait to what he has to say. React. There'll be plenty of time to get in to capture any upside or downside alpha. Either way, guys, my view is, as it always has been, buy the dip, don't trip. And guys, let's talk about sentiment. This is the fear and greed index. And guys, we are still in the extreme fear territory, despite some of the bullish price action we have gotten in the last couple of days. We're still firmly in the extreme fear territory. Now, generally speaking, guys, when we stay in the extreme fear territory for anywhere between 7 to 14 trading days, right? The average return 6 months later is about 8%. So this is where you want to start loading the boat, because we've been in this extreme fear territory probably since the start of March. It's been very close to about 10 trading days, and the risk to reward is highly skewed to the upside, particularly with some of the price action we've seen in the market as of late. Just remember, even though it says extreme fear, this side of the aisle should really be called the buy zone, and the extreme greed zone right here should really be called the sell zone. That is what you're really trying to do. Buy here, sell here. If you're contrarian in this market, you generally will make a lot of money. However, this type of extreme fear has seeped itself into the market, particularly with year-end 2025 forecasts. We've had some major players revise their targets, looking at stuff like Yardeni Research, Goldman Sachs, as well as RBC, Lori Calvasina. They all downgraded their price targets, particularly Yardeni Research. They had a 7,000 price target, now at 6,400. That's a big downgrade. Goldman Sachs and RBC both revised their targets to 6,200 from 67 and 6,500 respectively. So we are seeing the fear seep into the capital markets. I'm leaving my S&P 500 year-end target as is. I am still a firm believer we're going to have a back half loaded year. We're going to see the majority of the gains, particularly as all of this fear and uncertainty unwind. I could be wrong, but my price target is still firmly at 6,669, right here in line with Bank of America. That's my price target. And I think if we don't get to that target, we're going to get very close to that range, which does imply anywhere from 13, 14, potentially 15% upside from the close price yesterday, today, or Monday, around where we are right now. But look, these price revisions are not unfounded because we've seen very clear revisions in earnings. Looking at Q1 earnings, in a couple of weeks, we're set to begin Q1 earnings for the S&P 500. We're looking at 7.1% growth for this quarter. On the 31st of December, or the start of the year, we were looking at 11.6% growth. So we've seen a significant revision there, and a lot of that has come from the major sectors. Look at healthcare, 40% to 35% revision, 16 to 14.7% in info tech. We've seen major revisions in comm services, almost a 50% haircut compared to the earnings estimate at the start of the year. Financials 7% to 2.6%, industrials 9% to 2.1%. We've seen some major revisions right here. The consumer discretionary sector holds stuff like eBay, Tesla, and Amazon pretty much going from 11% growth to virtually 0% as of today. We've seen some major downward revisions, more than we would historically see, and that is why we're seeing some of these major downgrades. However, guys, in the near term, in the year and now, the second week of March seasonally tends to be quite bullish. We tend to see about a 1% return in the second half of March. We have kind of started to see a bit of bullish price momentum come into the markets. So if we do get a bit of a tactical bounce here, that is completely seasonally normal. And that is kind of what we are seeing at the moment. We'll see if it materializes into anything larger. Nonetheless, do expect a little bit of bullish momentum to round out the month of March. Now, let's go ahead, guys, and talk about the macro. So looking at some sentiment polling we got here, Goldman Sachs asked, what is the largest policy risk to the economy in 2025? The overwhelming majority, the super majority, 60% of investors said tariffs. That is the big reason why we're seeing all of this volatility. It just has to do with Trump's policies, right? 17% or in a strong second place was G right here, a failure to address fiscal sustainability. And then D and F were in tied for third place, which is failure to extend the 2017 tax cuts, as well as Doge or other spending cuts. So all of these are kind of linked together, and pretty much what this poll is telling us is that the biggest risk to the market is simply Trump and his policies. However, investors are very optimistic that the 2017 Trump tax cuts will be fully extended. 2/3 of investors expect the 2017 tax cuts to be fully extended, both saying yes fully, yes partially. Very few people saying no or have no view at all. Long story short, we probably will see them. Generally speaking, the consensus tends to be right, but it really depends on what the political environment is going to look like. Politics has been very divisive. However, Republicans do have control of both the Senate and the House, but they will need some Democrat support to get this moving in the Senate. Looking at the Fed's GDP now, guys, we continue to see a little bit of up revisions. This is exactly what I said would happen. We got a whole bunch of imports, and now we're seeing the inventory adjustments for those imports. Nonetheless, Atlanta's Fed GDP now estimate is still for a slightly negative 2.1% estimate. We'll see how this materializes. Other estimates are saying around about 2%. The blue blue chip consensus has actually moved down from their initial consensus, but still well within the positive range, none of them below the zero line right here. Now guys, let's dive into the consumer really quickly. Some very interesting data here from Moody's per Bloomberg, and the share of US personal spending by income bracket is undoubtedly driven by the top 10% of earners. About 50% of personal spending in the US is driven by the top 10%. The 60 to 90% bracket drives just over 30% of spending. You can see the bottom 60% of the US economy contributes a negligible amount to overall personal spending, less than 20%. So if the consumer starts to pull back, particularly the high-end consumer, which is not really price sensitive, but if you do see a pullback here, it will be material, particularly to the economy, the market, and by extension, stocks as a whole. However, I'm very optimistic because when we look at stuff like this, disposable income and compensation growth continues to run above and ahead of inflation. And this essentially tells us that the consumer will be able to hang in there. Real income growth is at all-time highs, and incomes and compensations are both comfortably growing faster than inflation. For example, look at the 1-year annualized rate, right? This is PCE of 2.5%, employee compensation of 4.6%, and 4.4% for disposable income, respectively. In fact, the numbers look far better when you look at 3-month annualized 2.9% PCE and then 5.7% and 6.7% in disposable income and employee compensation, respectively. So as long as we see these types of figures, right, I think the consumer will be able to hang in there. As long as real income growth is strong, positive, and well above PCE, the consumer will hang in there, and that median quartile and the top quartile of the market should continue to spend. One thing you don't want to bet against is the American consumer and American spending money. Looking at earnings for the rest of the week, guys, tomorrow there isn't much that I can see. Williams-Sonoma, that's about it. General Mills, that's before the open, and then Five Below after the close. That's about it. And we have a couple of big names here on Thursday, Friday as well. And then in terms of data tomorrow, the Fed interest rate decision, the FOMC economic projections, and the Fed press conference. That's all you need to focus on. The interest rate decision is to be left as is, and then the economic projections and Fed press conference. There's no consensus estimates there, but just expect the Fed to pretty much hold interest rates where they are. If we do get a cut, that might actually be seen as a bad thing. But what we really want to also wait for is Jerome Powell's take on the economy, the market, as well as Trump's policies for the most part. But I think this is going to be a non-event. And I think the economic projections are going to come in slightly dovish, and that should support the market. I think that's the general consensus. Anything outside of that can really move the market either to the upside or downside. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.